Something big is forming around XRP, and before we go any further, I want to be very clear about what this conversation is and what it is not. This is not a discussion about sudden price moves, short-term excitement, or emotional market reactions. It is not about predictions, timelines, or promises. This is a grounded, educational discussion about systems, structure, and long-term financial positioning. If your interest in markets is rooted in understanding how wealth systems actually evolve, rather than reacting to daily noise, then this conversation is meant for you. I want to begin by framing how I approach topics like this. I look at markets the same way an architect looks at a city or an engineer looks at infrastructure. The most important changes are rarely loud. They do not announce themselves with fireworks. They happen quietly beneath the surface while most people are distracted by surface-level movement. In finance, by the time something becomes obvious to everyone, it has already been forming for a long time. Something meaningful has occurred around XRP. Not in a way that excites headlines or fuels speculation, but in a way that signals structural relevance. Most people missed it because they are trained to watch charts, prices, and social media sentiment. They are conditioned to look at outcomes rather than foundations. Meanwhile, the real shift has been taking place where infrastructure, regulation, and financial plumbing quietly evolve. Before going deeper, let me say this clearly and calmly. Everything shared here reflects personal analysis and an educational perspective. It is not financial advice, and it is not intended to influence buying or selling decisions. The goal is understanding, not persuasion. The value here comes from clarity, not urgency. Now, to understand why something big may be forming around XRP, we need to step back and talk about how financial systems actually change. Real financial systems do not evolve through excitement. They evolve through alignment. Alignment between technology, regulation, institutional needs, and real-world use cases. When those elements begin to converge, even slowly, something structurally important is taking shape, whether or not the market is paying attention. Most people approach crypto the same way they approach gambling. They look for fast outcomes, dramatic narratives, and emotional validation. That mindset is not designed to recognize long-term positioning. It is designed to react, not to observe. XRP, whether people like it or not, has never been built for emotional traders. It has always existed closer to the infrastructure layer of finance than the speculation layer. That alone filters out a certain type of participant. Infrastructure is not exciting to most people, but it is where power accumulates. Roads are not glamorous, but every economy depends on them. Payment rails are not thrilling, but global commerce collapses without them. When you evaluate XRP through this lens, you stop asking emotional questions like why hasn't it moved, and start asking structural questions like where is it positioned within the system. Something important has been forming because XRP's role has been slowly clarified, not through marketing but through context. Over time, clarity emerges about what a system is for, who it serves, and where it fits. That clarity does not come from social media enthusiasm. It comes from real-world constraints, regulatory boundaries, and institutional requirements. When people talk about change in financial markets, they usually point to prices. They look at a chart, notice a sudden move, and assume that is where the story begins. In reality, price is almost always the last chapter, not the first. The real story starts much earlier in places that are quiet, technical, and frankly uninteresting to most people. It starts at the level of infrastructure. If you think about how lasting wealth has been built throughout history, it was rarely created by chasing excitement. It was created by understanding what was becoming essential before it became popular. Railroads were not valuable because people liked the idea of trains. They were valuable because they became the backbone of commerce. Electricity did not matter because it was exciting, but because every business eventually depended on it. The same principle applies to financial systems. Infrastructure is the foundation that allows activity to happen at scale. When infrastructure improves, efficiency improves, costs go down, reliability goes up. But none of this shows up immediately in market prices. In fact, during the period when infrastructure is being built or refined, prices often do very little. That is because markets tend to reward visible outcomes, not invisible preparation. This is where many investors lose their edge. They wait for proof in the form of price movement, headlines, or excitement. By the time those signals appear, the underlying work has already been done. The opportunity to understand the system early has passed. In my experience, the best opportunities come from paying attention to what is becoming necessary, not what is becoming popular. In finance, infrastructure includes things like settlement systems, payment rails, legal frameworks, and operational reliability. These are not topics that generate enthusiasm at a dinner party, but they are the things that large institutions care about deeply. Institutions do not move money based on stories or emotions. They move it based on safety, clarity, and long-term usefulness. They ask simple questions. Does this work consistently? Is it compliant? Can it scale? Does it reduce friction rather than create new risk? When a financial tool begins to align with these requirements, something important is happening, even if no one is cheering. That alignment does not guarantee success, but it does increase relevance. And relevance is far more durable than excitement. Excitement fades. Relevance compounds. One of the mistakes individual investors often make is assuming that if something is not moving in price, it must not be progressing. That assumption confuses activity with value creation. Some of the most valuable businesses in the world spent years building quietly before the market recognized their worth. During that time, patient observers were not rewarded with excitement. They were rewarded with understanding. Another important point is that infrastructure is not built for speed. It is built for stability. Fast systems that fail are useless. Slow systems that work every time become indispensable. Financial history favors the second category. When you recognize that, you stop expecting infrastructure-focused assets to behave like speculative instruments. So when we say that real financial shifts begin at the infrastructure level, we are really talking about where durable value forms. Price will eventually reflect usefulness, but usefulness must come first. If you train yourself to look for usefulness before price, you change your entire approach to markets. That way of thinking is not glamorous, but it is effective. It encourages patience, it reduces emotional decision-making, and most importantly, it aligns you with how real financial systems actually evolve. Over time, that mindset does not just protect capital, it helps grow it quietly, steadily, and with far less stress. Most people in markets believe they are watching. Gee, what matters, but in reality, they are watching what is easiest to see. Charts move every second, headlines refresh constantly, and opinions flood in from every direction. It creates the feeling of being informed when in fact it often creates the opposite. The most important developments in finance rarely announce themselves on a price chart. They take place quietly in the structure of the system itself. When someone focuses primarily on charts, they are reacting to the outcome of decisions already made by others. Price is a record of the past, not a guide to the future. It reflects emotion, momentum, and short-term consensus far more than it reflects long-term usefulness. By the time a price move captures attention, the underlying cause has usually been in motion for a long time. Watching charts without understanding the system is a bit like judging the health of a business by the daily movement of its stock instead of its cash flow, its customers, and its competitive position. This habit of chart watching trains people to think in short bursts of time. It encourages impatience and emotional swings. When prices rise, confidence appears. When prices fall, doubt follows. Neither reaction is grounded in an understanding of what is actually being built. Over time, this kind of behavior does not compound knowledge or wealth. It compounds stress. Systems, on the other hand, require a different kind of attention. A system is not defined by daily movement. It is defined by reliability, adoption, and integration. Financial systems evolve when they solve real problems more efficiently than existing solutions. That evolution is slow, deliberate, and often invisible. You do not see it in a single chart pattern. You see it in gradual alignment with real-world needs. Most people miss structural developments because structure does not provide emotional feedback. There is no rush, no thrill, no immediate validation. But structure is where lasting value is formed. Businesses that dominate industries usually do so because they built systems that others rely on, not because their stock price moved first. The stock price followed the system, not the other way around. When investors ignore systems and focus only on charts, they often mistake noise for progress. A sharp move feels important, but importance is not measured by speed. It is measured by staying power. Many things move quickly and disappear just as fast. Very few things move slowly and then remain essential for decades. Understanding systems also changes how you interpret silence. When nothing seems to be happening, it may simply mean that the work is being done out of sight. Foundations are laid quietly. Regulations are clarified without fanfare. Infrastructure is tested, refined, and strengthened without applause. None of this excites short-term traders, but it matters greatly to long-term thinkers. In my experience, the best way to miss important developments is to demand constant excitement. Markets are very good at supplying excitement, but they are not obligated to supply value on a daily basis. Value is built patiently, often in ways that do not translate into immediate market reactions. When you shift your focus from charts to systems, your behavior changes. You stop reacting to every movement. You start asking better questions. Is this becoming more useful? Is it more reliable than it was before? Is it better aligned with the real needs of the financial world? These questions do not have daily answers, but over time they provide clarity. The irony is that by the time systems become obvious, the charts will already reflect it. The people who benefited most were not those staring at screens all day. They were the ones paying attention to what others found boring. In Mark E.T.'s, boredom is often the price of admission for long-term understanding. Large institutions do not behave the way individuals do, and that simple fact explains much of the confusion people experience when watching financial markets. Individuals are free to act on emotion, stories, or short-term opportunity. Institutions cannot afford that luxury. They are responsible for stability, compliance, and long-term continuity. Their first priority is not making the fastest return, but avoiding unnecessary risk. Because of this, institutions move slowly, and they do so on purpose. Slowness is not a flaw in their decision-making process. It is a feature. Before adopting or relying on any financial tool, institutions ask whether it works under stress, whether it fits within regulatory boundaries, and whether it can scale without breaking. Excitement does not enter the equation. If anything, excitement is viewed as a warning sign. Many people interpret this slow movement as disinterest or rejection. In reality, it is often evaluation. Institutions watch for consistency over time. They want to see that a system performs the same way in good conditions and bad ones. They want to know that rules will not change suddenly and that legal and operational risks are understood. Only when uncertainty is reduced do they begin to engage. This is why alignment matters more than innovation alone. A tool can be technologically impressive and still be unusable for large financial players. Without clear regulation, operational standards, and accountability, innovation remains theoretical. Institutions are not paid to experiment, they are paid to preserve trust. When alignment between technology and institutional requirements begins to form, something meaningful is happening, even if it looks uneventful from the outside. Patience plays a central role here. From the perspective of an institu, time is an ally. Waiting allows weak ideas to fail and strong ones to prove themselves. Over time, risk is either reduced or exposed. The systems that survive long periods of scrutiny earn credibility, and credibility is far more valuable than attention. Individual investors often underestimate how much weight institutions place on risk reduction. Making money is important, but losing it in a way that damages reputation or stability is far worse. This leads institutions to favor tools that quietly improve efficiency over those that promise dramatic change. Gradual improvement is easier to manage than sudden disruption. When people expect institutions to move quickly, they are projecting individual behavior onto organizational systems. That mismatch leads to frustration and misinterpretation. In reality, when institutions finally act, they tend to do so decisively and at scale. The waiting period feels long, but the execution phase can reshape entire markets. Understanding this dynamic helps separate impatience from insight. If you expect immediate confirmation in the form of price movement or public announcements, you will likely be disappointed. Institutional positioning often occurs long before it becomes visible. Agreements are tested. Systems are integrated, processes are refined. All of this happens quietly. In my experience, the best investments are not those that create excitement, but those that steadily reduce uncertainty. When uncertainty declines, participation increases naturally. No marketing campaign can replace that process. It must be earned over time. So when you see a system gradually aligning with institutional needs, patience is not just required, it is rewarded. The absence of noise does not mean the absence of progress. Often, it means the opposite. It means the work is being done carefully, with long-term consequences in mind. One of the most valuable lessons an investor can learn is that not all opportunities announce themselves in the same way. Some arrive with excitement, constant movement, and emotional energy. Others arrive quietly, asking for patience and restraint. The market tends to reward the second group far more often than the first, but only for those willing to observe rather than react. Long-term positioning is not about predicting what will happen next week or next month. It is about understanding where a system is likely to be useful over many years and placing yourself in a position where time works in your favor. This requires a calm temperament. Emotional participation, by contrast, usually leads to buying enthusiasm and selling fear. That cycle feels active, but it rarely produces durable results. When people treat markets as a place for constant action, they confuse motion with progress. Progress is measured by improvement in fundamentals, not by how often prices move. The most successful investors I have known were rarely the busiest. They spent more time thinking than trading. They understood that the market exists to serve their patience, not to test their nerves. Assets built for infrastructure and settlement behave very differently from those driven primarily by speculation. They are not designed to entertain. They are designed to function. Expecting them to produce constant excitement is like expecting a power grid to be thrilling. Its value lies in reliability, not drama. When it works quietly every day, no one notices. When it fails, everyone cares. This difference explains why many people lose interest in long-term positions during quiet periods. Silence makes them uncomfortable. They interpret a lack of movement as a lack of value. In reality, quiet periods often mean that nothing is broken. Systems that require constant attention are usually fragile. NS that operate steadily tend to endure. Calm observation allows you to see what emotional participation hides. When you are not reacting to every price change, you can evaluate whether something is becoming more useful, more trusted, or more integrated into real-world activity. These changes do not show up on a daily chart, but they matter far more over time. Another advantage of long-term positioning is that it reduces mistakes. Emotional decisions are usually rushed decisions. Rushed decisions often ignore risk. Patience forces you to think in probabilities rather than possibilities. It encourages humility. You accept that you do not need to act on every piece of information to do well. Markets are very good at transferring wealth from the impatient to the patient. That process does not require brilliance, it requires discipline. The ability to sit still when others feel the need to act is an underrated skill. It is also one of the hardest to develop. When you focus on long-term positioning, you stop trying to be right all the time. You focus instead on not being wrong in a permanent way. Avoiding irreversible mistakes is far more important than capturing every opportunity. Time rewards those who survive. In the end, calm observation is not passive, it is selective. It means choosing what deserves your attention and ignoring what does not. It means trusting that meaningful change unfolds at its own pace. For investors who can do that, the market becomes less of a source of stress and more of a partner in long-term wealth building.